Ladies and gentlemen, good morning and welcome to the Max Healthcare Institute Limited earnings conference call. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Suraj from CDR India for opening remarks. Thank you, and over to you.
Thank you, Ryan. Good morning, everyone, and thank you for joining us on Max Healthcare's Q4 and FY-2025 earnings conference call. We have with us Mr. Abhay Soy, Chairman and Managing Director, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Keshav Gupta, Senior Director, Growth, M&A and Business Planning. We will begin the call with opening remarks from the management, following which we will have the forum open for an interactive Q&A session. Before we begin, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks. Thank you, and over to you, Abhay.
Good morning, everyone, and thank you for joining us on Max Healthcare's fourth quarter and full year FY25 earnings call. This year has been a pivotal one for us, fueled by focused strategic decisions, disciplined execution on ground, and significant milestones that have set new benchmarks. After acquiring hospitals in Nagpur and Lucknow in the last quarter of previous year, FY 2024, we acquired the 500-bed Marquee JP Hospital in Delhi NCR this year. As part of our asset-light expansion strategy, we commissioned Max Dwarka and signed up contracts for build-to-suit hospitals to be set up by our partners in Mohali, Thane, and Pitampura, Delhi. During the year, in what could have been a year of moderate growth otherwise, we initiated multiple long-term growth plans, including the announcement made last week regarding acquisition of approximately 1-acre land parcel adjoining our fully occupied 400-bed hospital in Vaishali. Our recent acquisitions, Max Lucknow, Max Nagpur, and Max Noida, played a key role in accelerating top line and EBITDA growth. Our overall financial performance for FY25 reflected this momentum, with a year-on-year growth of 26% in revenue and 22% in EBITDA. Notably, Max Lucknow demonstrated year-on-year growth of 56% in revenue and 102% in EBITDA, while Max Nagpur reported a year-on-year growth of 23% in revenue and 86% in EBITDA in their first year since acquisition. Max Noida is being integrated into our network and reported a gross revenue of rupees 228 crores with an operating EBITDA of rupees 48 crores at a margin of 21% post-acquisition since October 2024. Additionally, our newly operationalized asset-light hospital in Dwarka achieved EBITDA break-even in 6 months, a new record. The hospital clocked a revenue of rupees 171 crores and an EBITDA loss of 29 crores for the entire year FY25 since becoming operational in July 2024. It exited the year with a revenue of approximately rupees 30 crores per month and 73% occupancy on the 235 beds in March, with balance 68 beds yet to be opened. We are already looking forward to embark on the next phase of expansion of 200 beds at this facility. These results demonstrate the resilience of our operating model and the caliber of our teams. It reinforces our confidence as we prepare to commission 3 new brownfield towers at Max Smart, Max Nanavati, and Mohali Hospital within the next 3 months and complete our greenfield facility in Gurgaon by the end of this year, adding approximately 1,500 beds in total. Among the year's other standout achievements, we are proud to have been ranked amongst the top 20 companies in S&P BSE 100 Index and recognized under the Next Leaders category for corporate governance excellence by Institutional Investor Advisory Services, India's largest proxy advisory. This recognition underscores our unwavering commitment to the highest standards of transparency, accountability, and integrity in corporate governance. On that note, we would like to highlight that we continue to undertake corporate actions to simplify the holding structure, improve governance, and optimize cash flows. To that effect, we have concluded merger of two wholly owned subsidiaries, Alps Hospital Limited and Max Hospitals, and Allied Services Limited. We have also filed an application with the NCLT for merger of Crossley Remedies Limited and JP Healthcare Limited, which will, in effect, reduce our outflow on the acquisition by rupees 200 to 225 crores. Now coming to the performance highlights of the fourth quarter, which is the 18th consecutive quarter of year-on-year growth. Our average occupancy for the network stood at 75% versus 74% in Q4 last year, and at similar levels in the trailing quarter. Whilst the occupied bed days grew by 30% year-on-year and 2% quarter-on-quarter. Do note that the network occupancy stood at 78% if we exclude Max Noida, which is still being integrated into the network. Something which we completed the acquisition of in November 2024. Average revenue per occupied bed for the quarter stood at 77,100, remaining relatively flat year-on-year and growing 2% quarter-on-quarter. Like-for-like ARPOB for the existing units grew by 7% year-on-year and 2% quarter-on-quarter. Network gross revenue was 2,429 crores, compared to 1,888 crores in Q4 last year and 2,381 crores in the previous quarter. This reflects an increase of 29% year-on-year and 2% versus the trailing quarter. Of this, new units reported a gross revenue of 353 crores, while existing units registered a year-on-year growth of 12% in revenue, driven by 6% growth in occupied bed days and 7% growth in average revenue per occupied bed. The international patient revenue stood at rupees 202 crores, registering a growth of 28% year-on-year, despite contraction in patient footfalls from Bangladesh and Yemen due to continuing political unrest. Network operating EBITDA stood at 632 crores, reflecting a growth of 26% year-on-year and 2% quarter-on-quarter. This includes rupees 67 crores EBITDA contribution from new units. Network operating EBITDA margin stood at 27.2% for the quarter. Existing units reported an EBITDA margin of 28.5%. Annualized EBITDA per bed for the network stood at rupees 74 lakhs. Like-for-like EBITDA per bed for existing units stood at 84 lakhs, reflecting a growth of 7% year-on-year. Profit after tax, excluding exceptional items and one-off tax gains, was rupees 376 crores versus 311 crores in the fourth quarter last year, and rupees 372 crores in the previous quarter, reflecting a growth of 21% year-on-year. There was an exceptional item of rupees 74 crores towards CIS charges paid to YEDA for seeking permission for change in shareholding of JP Healthcare Limited prior to acquisition, and one-off gain in tax costs of rupees 18 crores, consequent to voluntary liquidation of a wholly owned step-down subsidiary in the third quarter FY-25. Overall, free cash flow was rupees 422 crores during the quarter. Rupees 390 crores was deployed towards ongoing capacity expansion projects and upgradation of facilities at acquired hospitals. Consequently, net debt for the network came down by rupees 32 crores to rupees 1,576 crores at the end of March 2025. Continuing our effort to support the local communities, we treated approximately 36,500 outpatients and 1,200 inpatients from economically weaker sections of the society entirely free of charge, worth rupees 53 crores at hospital tariff. Both our strategic business units continue to report significant growth in their revenue and profitability. Max at Home reported a top line of rupees 56 crores, reflecting a robust growth of 22% year-on-year. It offers 15 specialized service lines across 15 cities with over 50% repeat transactions. Max Lab reported a revenue of rupees 46 crores, reflecting a strong growth of 19% year-on-year. It provides services in over 50 cities through its network of more than 1,200 collection centers and active partners. Now coming to the status of our expansion projects. 268 beds at Nanavati in phase 1. The interior work is in progress and we expect to commission this facility within 90 days. 155 beds at Mohali. Finishing work is underway and we expect to commission this facility within 90 days as well. Plans to add additional 45 more beds through internal reconfiguration will be initiated once the new tower is completed within 90 days. 400 beds at Max Smart at Saket Complex. Interior work and MEP fit-out works are ongoing and we expect to commission this facility latest by second quarter FY-26. At Max Lucknow, we have added 128 beds on floors 9 to 12 as communicated previously. Through internal reconfiguration, we have added 35 beds in May and plan to add 39 more beds in the next 12 months. We expect to complete the Onco block here by the second quarter this year. 500 beds at Sector 56 Gurgaon. Structural work is in progress. We expect to commission the facility by end of this calendar year. At Dwarka, the Onco block is expected to be commissioned by the third quarter this year. All of these are on schedule and we will see significant ramp up in our capacity over the next 12 months. 127 beds at Max Nagpur. 12 beds have been added in October 2024. For the balance beds on additional floors, we are waiting EC approval, that's environmental clearance approval. While the bill of quantities detailing has started, we expect to complete this project within 24 months. 397 beds at Patparganj. We already received the environmental clearance. The tendering work is in progress. The project continues to be largely on schedule. 550 beds at Max Vikrant Saket. We are still awaiting the clearance from Forest Department for tree transplantation. All other statutory approvals are already in place and we expect to complete the project by 2028. 400 beds at Zirakpur, Mohali. Our partner is currently awaiting EC approval and has initiated the tendering process, detailing the contractors, etc. The project is expected to be completed within the next 30 months. 140 beds at Vaishali. As announced earlier, we have acquired the land adjoining to Max Vaishali and will be initiating drawings, detailing, etc. in the next couple of months. We expect to complete this brownfield project in the next 30 months as well. Presently, the Vaishali hospital is operating at 83% capacity utilization. And finally, moving on to the overview of the company's performance for the full year ending March 2025. Network gross revenue stood at 9,065 crores, reflecting a growth of 26% year-on-year. New units contributed to 938 crores to the gross revenue. Overall network operating EBITDA grew by 22% year-on-year to rupees 2,319 crores, reflecting a margin of 26.8%, while EBITDA per bed stood at rupees 70 lakhs. Existing units reported an EBITDA margin of 27.9% and EBITDA per bed of rupees 80 lakhs. During the full year, we generated rupees 1,447 crores of free cash flow from operations after interest, tax, working capital changes and routine capex. Rupees 1,182 crores was deployed towards ongoing expansion projects and upgradation of facilities at acquired hospitals. Rupees 146 crores was distributed as dividend and rupees 1,716 crore net of cash at JP Healthcare Limited was used for the JP acquisitions. With this, would like to open the floor for any question and answers.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Amey from JM Financial. Please go ahead.
Yeah, thank you so much for taking my question. Congrats on the management and good numbers. So, first question I have, if we can give information on the profitability of the acquired units like Nagpur, Noida, Lucknow for the quarter.
Like I mentioned, there's been, like I mentioned in the speech, as far as Lucknow Hospital is concerned, we had a 56% growth in revenue and 102% growth in EBITDA. Nagpur has reported a 23% growth in revenue, 86% growth in EBITDA. The Noida Hospital, which we completed the acquisition in November, has a gross revenue of 228 crores, and we had a 48 crore EBITDA at 21% margin. I think with respect to, have we given the exact numbers of the...
No, so we're not given the... So I think this year, this quarter onwards, because of the fact that these two of these hospitals were acquired in Q4 last year. For example, the Alexis was acquired in February, and Lucknow was acquired in March. So that is the reason why we don't, because it's very tough to now separate the last year number into two parts, saying this is without that, etc. So that's the reason why we haven't put the numbers there. But I think nevertheless, you have the overall numbers with you. We have 67 crores of EBITDA from new units, which is 19.4%. Now, if I take out Dwarka, Dwarka is just broke even in December, and even this quarter also there is a small kind of EBITDA from that hospital in Q4. If I take out Dwarka, our EBITDA margin is 24.9% in the new units.
Sure. So the reason I wanted to ask because how much margin expansion still can happen in these units, except Dwarka, obviously, which is recently commissioned, but the other three units, how much margin expansion scope is there for next 1 to 2 years?
No, significant. I mean, this is the first year of acquisition. As by the time you put your building blocks in place, you must appreciate that takes some time. So I think clearly in terms of bed utilization, just to give you an example, although you had in Lucknow, you had expansion of EBITDA by 106%, yet there is no radiation oncology there. There's no bunker, right? And that bunker is going to come into play at the end of H1 this year. And once that happens, the oncology business, which even currently is not anywhere near the oncology business of the rest of the hospital, there's a major move up over there. If you look at Nagpur, for example, we're already now approaching very high capacity utilization. The teams are coming in play and so on and so forth. We're already looking at the next phase, which is, adding another 160, 150 beds over there. So once that happens, that gives you a major fillip because, you don't have any capacity left over there. As far as Max Noida is concerned, you're operating at, you bought a unit which is operating at less than 50% occupancy. So you have 50% more occupancy, higher sort of RPOBs, as well as all the clinical programs that are coming. So typically when you do these acquisitions, right, I mean, the first year you'll have less of a sort of improvement curve, in terms of absolute value. Maybe in percentage terms, you're operating off a smaller base. But the second year is when you're going to have that. And each one of these, whether it's JP, whether it's Nagpur as well as Lucknow, also affords significant further brownfield expansion. So, I mean, you will have yields coming out of years to come.
Also, I think the important question is to say that we have very respectable margins. For example, Lucknow margin is more than 30%. Right, Nagpur margin is around 22%, probably more. And JP will also be in the same range. I think the main thing is that we want EBITDA per bed to improve now, which means that we have to, put medical programs which are higher end. And just to say that new units, overall the EBITDA per bed is 54% of the rest of the net worth, which means we have to really grow that number. And that's how you will find that, and that's one of the reasons why you find that the revenue growth and EBITDA growth are EBITDA growth is a bit tapered compared to revenue growth because the share of new hospitals is going up and their EBITDA per bed is lower than the rest of the network.
But going forward, you're going to see that the EBITDA growth will outstrip revenue growth there. Not that the revenue growth is slowing down. I think there's still enough, more than enough fuel over there.
So the second question I have on that itself, because we have said that 1,500 beds brownfield expansion will happen in next year. So this year we have seen a lot of acquisitions. So what are the objective next year? Is it a brownfield focus year, or you think the M&A would still be there?
No, I think it's not one at the cost of the other. I think the brownfield is already under construction. It's already been built. So if you look at Mohali Hospital, is operating at 80% plus 85% kind of occupancy levels. Okay, and so you're really that number of beds which are coming in, which should be very, very quickly taken up. I mean, that's the whole purpose of brownfield. Now, similarly, if I look at Mumbai, right, I mean, the next 90 days, again, you're going to have these beds come up, but that solves the problem of the Mumbai hospital, right? I mean, then Max Saket, again, is at a very, very high occupancy, and that's our main hub. I mean, we're really crying for space and more beds over there. So I think those beds don't, I mean, and the balance sheet is something which is completely different. So here are three brownfields we are doing. Gurgaon, Sector 56, as you're aware, Gurgaon for us is the highest ARPOB, the highest EBITDA per bed market. So again, and with this new hospital, which is very, very well located over there, Sector 56, we are looking to do the same sort of encore, have the same sort of results that we've had in Dwarka. That has nothing to do with our balance sheet and our capability of doing other things. So we will continue seeking, acquisition opportunities also. But, like I said, we have to be able to touch base on, or clear two of our filters. One is the 20 to 25% ROCE within 4 to 5 years, as well as in markets which are where at least we have one or two of our peers. And if these two conditions are met, we are happy to look at acquisitions. And we continue to pursue them.
Sure. Thank you so much. I will join that.
Thank you. The next question comes from the line of Damayanti Kerai from HSBC. Please go ahead.
Hi, good morning, and thank you for the opportunity. My first question is on your, payer situation at new hospitals. So, if I look at your institutional bed share, you mentioned it went up to, say, 33% in 4Q. So, is it because you are putting more of these scheme patients to really, move up in the occupancy, cover up the fixed cost, and then, I think, can you please comment on it?
No, so that's absolutely right. I mean, if you look at typically when you open a new hospital, Dwarka, for example, you kind of fill it with, all payer groups, because really the first focus is to get the occupancy up, and then you start turning it. If I look at Nagpur, for example, it was operating at 50% odd% occupancy prior to acquisition, but we took up the business over there for institutional business in order to ramp up the occupancy, and the occupancy now is, it's like almost full up. It is full up. So what that does is it helps you occupy your idle beds and yet cover fixed costs, or at least a part of it, and it all trickles down to EBITDA. So from our standpoint, so long as contribution is positive from any payer group which has idle capacity, it makes sense to do that. So we continue to do that, and that's what is paying us the yields and dividends returns as well. I mean, there's no sense in keeping beds idle. If you have any idle beds, you must do institutional business over there. So we continue with that strategy.
Sure. So at what occupancy you choose to, optimize between institutional or like TPA patients? So say you ramp up to 40-45%, or what level you take that decision?
See, look, we can go up to, let's say, about 80% occupancy, right? Mm-hmm. So till I get to 80% occupancy effectively, I can take institutional patient. If suppose I have 60% occupancy other than institutional, then for the balance 20%, I'll take institutional. I will not have an idle bed.
So look at it the other way around. As long as we are not refusing cash patient or insurance patient, we like to do the insurance patients.
That's right. So any growth in cash and insurance patients will be accommodated first.
Okay, got it. Thanks. My second question is on international patient revenue. So I remember, a few quarters back, we are talking about initiatives or incentives provided by the government to ease flow of the medical international tourists in India. So on back of that, have you seen any incremental, or I say any meaningful pickup in your international patient business? Because if I see, I think it's still like 9% of your hospital revenue, although on a bigger base, but any significant or notable push which you might have seen from these initiatives?
We mean 9%, but please understand we've increased capacity. We've increased capacity by 30%, right? And the growth in that business this quarter has been 29%, which is a significant increase. I mean, I wouldn't entirely put it down to government of India because that's a slow move. But as the image of the country sort of improves, but then you have certain setbacks, right? I mean, you also have geopolitical unrest. You had that issue with Bangladesh, you had it with Yemen, etc. We most recently had this with the Pakistan issue where the airspace has been closed. So some of these have those, but you'll always be 2 steps forward, 1 step back. But if you were to draw a line, I think we've had more than a 25% growth in this business for a long period of time, and 29% is acceleration in spite of these setbacks.
Got it. And my last question is, if I look at your ARPOB on a network basis, including new and existing units, so it's somewhere around, say, 75,000 for FY25. So what kind of growth we should look at this parameter, given now going ahead also we will be having mix of existing plus new beds on a consistent basis?
It is irrelevant what the ARPOB is, right? I mean, by the overall ARPOB is. I mean, today if I acquire something for $100 and it gives me $25 of EBIT, it's a 25% ROC. I don't worry about whether what it's producing is lower ARPOB or higher ARPOB. So overall, I mean, what we have to look at is what is happening to overall EBITDA, what is happening to overall EBITDA per bed, what is happening to vis-a-vis what we are deploying.
Got it. Okay. Thank you.
If I look at the ARPOB growth of existing facilities gone up by 7.5%, but when I buy something worth lower ARPOB, okay, that drags it down. But the fact is, should I not be acquiring something worth lower ARPOB, even if it's very, very high on ROC, even if I'm getting it very, very cheap? Answer to that can never be don't acquire. Answer to that always has to be yes, you must. We are so long as I can deploy money at a 25%, 20%, our ROC is pretty high, it's 25% overall.
Yep, that's clear. Thank you.
Thank you.
Thank you. The next question comes from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. I think in the presentation we mentioned that the IP growth at 3.5% was impacted due to, I think, lower footfall in internal medicine pediatrics. Is there something to read into this? Because it isn't as if March is a seasonal quarter. So just trying to understand the reason for this weakness.
No, so typically, when you compare quarter on quarter, quarter 3 happens to have more internal medicine patients, and quarter 4 happens to have less internal medicine patients. So I think there's that impact of seasonality which comes in. I think that's what we're trying to explain there, because the share of internal medicine coming down.
But the fourth quarter, okay, so the drop you're talking is on a quarter on quarter. But even if I were to look at a year on year, it's just a 3% IP volume growth. So hence I was wondering if there is anything one quarter.
There's a lot of these dengue patients, etc., which comes up. Sometimes, it happens in October, sometimes it goes into the quarter 4. So I think that's probably the change that we refer to here.
Okay, got it.
Last year, if I recall, October had a significant amount of dengue patients, particularly in places like Mohali and Dehradun, etc., where we had massive dengue. For some strange reason, it went into October. This year there wasn't, so I guess...
Yeah, but I was thinking about March versus March. So, but I understand that there could be...
Yeah, but nothing to read into it. It could also be, if you look at some of the new facilities, etc., that we acquired, they weren't there last year, now they are. They may have a lower level of feeds and internal medicine and so on. So, but there's nothing to, none of our signs are showing any. If I look at the number of OPDs overall, there's been a significant increase, I think.
Even IP number versus last year, they've grown by 6% existing quarter to quarter, nearly also about 5%. So,
PEDS and internal medicine specifically.
Medicine so in the fourth quarter, generally the surgical business comes up, so IP volumes goes up. So,
year on year.
No, it'll be basically confliction of the new hospital versus the old hospital. Right?
That's right.
Okay, got it. The second question is on Dwarka. I think in the presentation we mentioned that the Dwarka achieved break-even in December quarter and based on the loss number, if I were to calculate, I still see there is a loss in Dwarka in the quarter. It's still making a EBITDA loss. Is that correct, or am I missing something here?
No, there is no loss. After break-even, we have not made a loss. We continue on it's obviously lower profit, but it's definitely ever since. So it's not as if December we broke even and then January, February or March, any of the months that we've lost money. We haven't. Since then till date, we've not lost money. We are only occupancy moved up. Your flow through to the bottom line has improved since then.
Okay. And have we ramped up more beds in Dwarka from the 140 that we'd commissioned, and what's the plan for the ramp up for the rest of the beds?
No, so we already had 235 beds, and we have an occupancy of 73%. That is March.
Okay.
We have 30 crores of revenue coming from that single hospital in the month of March, which I mentioned. So you have a 73% in 235 beds. We are expecting now anytime to be opening 68 additional beds.
Got it. Okay, this is helpful.
I mean, we basically already, we just sort of staff them as the occupancy increases. You know what I mean?
Understood. Yeah. Makes sense. Yeah. Thank you.
Thank you. The next question comes from the line of Prashant Nair from Ambit Capital. Please go ahead.
Yeah, thanks. Good morning, everyone. Just had a question on the expansion plan. Since there is no slide on that in this quarter's presentation. So the 1,400 odd beds that you were planning to add in financial year 26, that remains on course. Would it roughly be in the same range?
That's right. We usually have it in the investor presentation, not on the quarterly presentations. So if you see the investors presentation, it continues to be the same. We expecting in the next 90 days, within 90 days, both Nanavati 260 beds, Mohali 155 beds. I think by second quarter you will have Smart. By end of calendar year you will have the Gurgaon facility, and the midst you are also adding in Lucknow and other places. So you'll be hitting 1,500 beds, not 1,400 beds. In fact, probably northwards of 1,500 beds by the end of the year.
Okay.
By end of year.
Okay. And of these, how many would you operationalize this year? If you can just give an approximate range. I imagine the bigger project would have not all beds operational from the beginning. How do you calibrate that?
No, we'll ramp up. We'll be operationalizing, and there's a ramp up sort of this thing, etc. Of course, like Dwarka, for example, we didn't commission all 300 beds, although they're ready, right? What we commission is as per occupancy. So we started with in July, okay, and by March, like I said, we already at 73%. By April, May, it should theoretically be further. So going forward, we are opening another. So when you have 75% plus occupancy in any set of beds, that's the time you open the next lot. Now we're opening the final lot in Dwarka, and so roughly within the year we've been able to occupy all the beds.
And that was a greenfield. Majority of the beds that are coming up are brownfield.
Yeah. So, but Gurgaon should have the same trajectory as Dwarka, whereas the brownfield is much faster, right? The uptake is almost immediate.
Right. So that's what I was trying to figure out. So for the greenfield, so for example, for Saket, would the rule of thumb be that you initially operationalize, say, 50%, and then once that hits 75% occupancy, you add the next block? Is that how one should think about it when?
Well, you can think of it like that, but the only difference is that in a greenfield, you take 6 months to break even, right? So by the time you get to 75% occupancy, it probably takes you a year. In a brownfield, do it, almost in months. Like in a month or two, whatever, you'll just be ramping up capacity. So your take-up is much faster.
Understood. Thanks. And when you when you categorize into existing and new units, so new units would include all the acquired hospitals plus just the greenfield ones, or would you also include some of the brownfield?
All acquired units plus Dwarka. All acquired units plus Dwarka.
Yeah, and on going forward basis also, it is the greenfield plus the acquired.
That's right.
Thank you. Thank you very much. That's it from me.
Thank you. The next question comes from the line of Vivek Agarwal from Citigroup. Please go ahead.
Thanks for the opportunity. So, if you look at EBITDA, right, this year the company has done quite well, right? We have seen expansion in EBITDA margin in the existing units and even the new units, acquired units, the execution was quite well. Now we are seeing another, I think, 1,400, 1,500 beds coming up this year. So it would be great actually if you can just give some qualitative color how to look at overall EBITDA growth margins for the next couple of years. Thank you.
No, so I think, brownfields normally give you higher EBITDA margins, right, in percentage terms as well as everything else, because your fixed cost is already incurred. So primarily the brownfields coming, which is I think close to 1,000 beds, they should throw out significantly higher EBITDA margins. And I'm not going to give you any forward-looking statements, but theoretically they should give you higher EBITDA margins compared to your existing business. So I think that is, even if you are sort of occupying those beds with institutional business and whatever else, even then they give you higher EBITDA margins. That's what we've sort of analyzed from all our previous brownfields that we've done. So I think that should work out well for us. And again, you have, we literally increased capacity by 30% last year. Dwarka, of course, most of the year was, for the first 6 months was operating at a loss. And after that it's been profitable. So you'll see the full strength of Dwarka coming into the current year. You will look at the momentum of both Lucknow and JP sort of snowball in the current year. On top of that, you've got 3 brownfields which are coming. And the one greenfield which comes at the end of the year will produce some operating loss. But I think a startup like Dwarka did, but it should more than get set off or absorbed by what we are doing on the groundfield and the momentums of the others. So that's where we are. So I mean, I think we are probably going to be entering, if I was to look at it or make a forward-looking statement, the strongest year in the last 5 years that we had.
Thank you, sir. This is comprehensive. And just one more question. As I think there is a significant capacity expansion even by you as well as the peers. So how you should look at the situation as far as supply of doctors, medical talent, nurses, etc. Thank you.
I mean, look, the brownfield capacity additions don't typically require massive increase or increase in senior level clinicians. It doesn't, because it's the existing doctors, they increase their footprints within those hospitals and so on, because they are the ones who are seeking these beds to start with. I think other than that, I don't see massive capacity expansion literally happening. Other than one more hospital other than ours in the current financial year in Delhi NCR, or maybe 1.5 hospitals, really nobody else is coming in the current financial year and thereafter. We have a very strong presence in Delhi NCR. We've got about 14 or 15 facilities there. So we tend to pick the best of what is available. And, if I look at Mohali, it's not as if any new hospitals are coming. We're just expanding capacity. Mumbai, no new hospitals are coming right now. We're just expanding our brownfield capacity. So, I mean, I really don't see... but again, you have to keep in mind that in India, there is the need for quality healthcare, and new greenfields are required, greenfields, brownfields, and so on and so forth. And all the senior clinicians over the next years or a decade who are going to emanate are going to be emanating from current set of MBBS doctors, etc. that you have. Even today, the cost of MBBS, the salary is about 45 or 50,000 rupees a month. So your demand supply shows up in the salary standards as well, right? So I mean, I don't foresee shortage in senior clinicians.
Thank you, sir. That's from my side.
Thank you. The next question comes from the line of Piyush Kumar from Magnus Hathaway Investment. Please go ahead.
Yeah, am I audible?
Yes.
Yeah. So, sir, my question is, can we see the average revenue per occupied bed go into the territory of 80,000 plus in the coming quarters? And if yes, what specialty could be the main contributing factor?
I think all the specialties which have been growing should take you there. I mean, we had a 7% growth in the erstwhile kind of hospitals. The present hospitals are growing at a higher sort of this thing, etc.
So we are already at 77.1, ARPOB, right? 77,000 ARPOB is the current ARPOB. So I'm not sure what is 70,000 you're saying. But yes, there's a gap between the new units and the existing units. right? So obviously we have to, as Atanave mentioned, that we don't have a radiation oncology, for example, in Dwarka, even in Lucknow. Once we start that, then obviously that will add to the ARPOBs. But, we obviously want to, shorten the gap, but there still be a gap between a Nagpur ARPOB and a Delhi ARPOB, right? We can't really, visualize that. So there will be some difference, but I think we will, I would say shorten the gap.
You told me 80,000.
His target of 80. So, and the second part is that all the places coming up are in like Mohali, Saket Complex, Smart, Gurgaon, Mumbai, which are we're still calling it, but the numbers have a higher ARPOB in the current mix. So.
And sir, my second question is regarding the stock price. So sir, in the last 6 months, the stock price is range bound over 1200 levels. So any comment on that, sir?
You have to tell me. I have no idea how stock prices work.
Okay, thank you.
I'm happy to discuss operations and financials and balance sheet, but markets have their own territory.
Okay, thank you.
Thank you. The next question comes from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity, sir. So just if you could share, like for FY25, ARPOB, maybe like pair-wise, institutional ARPOB, international patient ARPOB, and let's say cash ARPOB.
No, so we typically don't share the ARPOB separately, but we do mention that what's the various parameters. So typically the international ARPOB is 1.3 times of the cash this time in this quarter. The institutional is around 40% lower than the cash. So that's the parameter that is coming to this quarter, right? So it changes from quarter to quarter depending on what the contribution of patients that we got from international and also the institutional. So institutional ARPOB has degrown a bit. It's degrown by around 3 to 4% in this quarter compared to previous quarter. But I think that's a movement which, so I would say there's nothing changed on the directionally in any of these ARPOBs.
And on a full year basis, you have to think about in terms of either growth or decrease, if you could share that.
No, so I would say similar trends as we see, but I think the recent trends are more important than the full year trends. So I would say that's what we see. If let's say the cash is 100, the interest will be anything between 1.3 to 1.5, depends on which quarter you talk about, right? And the PSU would be, in some quarter it is 62% of that 100, or sometime it is 57% of that 100. So that's the range that you have. And TPA, will be 8 to 9% lower than the cash. I mean, that's what it kind of works out. Yeah.
Thank you. That's it from me.
Thank you. The next question comes from the line of Kunal Lakhan from CLSA. Please go ahead.
Hi. Good morning. Abhay, you said earlier during the call that, your because of the brownfield expansion, the margins should improve, or rather it's accretive to the margins. So our existing units are operating at about 28.5% margin and, EBITDA of 84 lakh per bed. There is an upside potential to this going ahead, as per you then.
That's right. But that's the whole, I've always guided to that. Your brownfields have a higher EBITDA per bed and have higher EBITDA margins, because your management cost and your senior clinician cost is already incurred by the existing hospital, right? So any incremental beds that you have, even if you were to fill them with lower ARPOB businesses like institutional, etc., still give you a much higher, give you a higher EBITDA per bed as well as EBITDA margins below.
Sure. But as and when this incremental brownfield capacity stabilizes, right, where do you think these ARPOBs, or rather like EBITDA margins or EBITDA per bed would settle?
I'm not going to give you a forward-looking statement.
Okay, no worries. Okay. Secondly, on the free cash flow side, that we are generating some serious free cash flow from operations. And going by your newer assets are also reaching EBITDA break even faster. Any upfronting of your long-term guidance of say adding or doubling your capacity over the next 4 years? Any upfronting of that guidance?
No, so look, what we do is any guidance that we give, right, is based on us already having acquired the asset, breaking ground or permissions or whatever else it is. So it's not a blue sky kind of thing. So what I don't tell you is that, look, my belief is over the next 5 years, I will generate, let's say, 15,000 crores. So I will look at, tripling my capacity or whatever else it is. No, that's not how we sort of guide either. What I can tell you is that, look, we've guided that we are happy going up to 2.5 times debt to EBITDA. We have very, very little leverage on our balance sheet, on our books. We are going to be funding all of sort of our expansion mostly through internal accruals. And we have more than spare room to kind of acquire. And last year we did 3 acquisitions, right?
Yeah.
What is very difficult for me to do is guide, in terms of till the transaction is closed, that what we are doing. Now, there are other places that we're looking at expanding, putting up facilities, etc. But till I have that sign, I can't sort of this thing. I am sort of cognizant of the fact that at 2.5 times debt to EBITDA, we get money at 8.25, and we're able to deploy it at 24-25%. But, as and when the deals happen, we'll announce them. That number should, on a rolling basis, will only go up. So, today I'm guiding you by 2028, I may have 9,000 beds, but I'm pretty sure 1 year down the line, the number would have moved up.
Understood.
So availability of cash is not a constraint for the capacity addition, right?
But it's not only cash, even the balance sheet. We have enough room in the balance sheet.
Correct. Understood. Lastly, bookkeeping question. Can you give me occupancy numbers in Q4 for the newer units individually, Nagpur, Lucknow, Noida?
So Dwarka, I've told you, is 73%.
Yeah.
The older units were 78%. The Chitta and JP acquisition, which was completed in November, I think that's 46-47%.
46% average.
46%.
52% in JP Noida and 26% in
Chitta, right? And Chitta is a really small unit.
Okay.
And we obviously didn't pay anything much for it. We didn't have any EBITDA to start with.
Sorry, and how much you said for Lucknow and Nagpur?
70%. So Lucknow is 65% with the additional bed that we opened, right? So Lucknow operating capacity has gone up. And in fact, in this quarter, again, we will go up to 413 beds. It was 324 beds in last quarter. So we added beds in Lucknow. So on the additional beds that we added, on the overall capacity was 65%.
So on the operating capacity that we bought was what?
Yeah, that will be 209 beds on 234 beds, right? So it's 90%.
So it was 90% occupancy on the beds that we bought.
Yeah.
Understood.
After that, we keep ramping up the beds. So, if you look at the end number of beds today, then it is 67%. But this is basis the beds that we've added over there. Right?
Yeah, and some beds we brought on in this quarter, in quarter 4.
Yeah, so let's not.
Nagpur is 81% plus. Yeah.
Nagpur is 81% plus.
Okay, very helpful, sir. Thank you so much and all the best.
Yeah. Thank you.
Thank you. The next question comes from the line of Rajit Agarwal from Nilgiri Investment Managers Private Limited. Please go ahead.
Good morning, sir. First up, congratulations on good set of results and the overall growth achieved during the year. I just had 2 very quick questions. And this is not a concern exactly. The interest cost has been going up quarter on quarter. And just for how to model it, should we assume the current quarter as the run rate going forward, or is it expected to go up even further?
No, so we don't expect any material change in the number. I think this went up since the October quarter because we borrowed money for the JP acquisition of 1,000 crore. And then we had also taken 600 crores loan for the Sahara acquisition in March 24, right? So these are the, and you know, the that situation that we have is 1572 crores at the end of March, which means that these are the 2, primarily these are the 2, term loans that it is taken, which is actually reflected in the net debt. So unless we really do any major acquisitions, I don't think any major change expected in the interest cost as such.
So similar run rate for the remaining quarters.
Yeah. If we do an acquisition, then yes, there will change, right? Then
yes, sir. Yeah, absolutely. Second question, while Mr. Abhay touched upon this on the supply side, on the competition side, but specifically given that a peer of yours is coming up with the same number of beds in Gurgaon and at the similar premium location, do you think that is going to impact your numbers or the overall scenario for the next 1 to 2 years?
No. I'm not seeing any impact on my business. We have a very large network in Delhi NCR. We've got, like I said, we've got 14 or 15 hospitals. today, in terms of number of locations, we are twice the number of locations that our next three peers, have put together. In terms of number of beds, we are equal to or more than the number of beds all of them have put together in NCR. We've got 35,000 healthcare workers, of which 20,000 live in Delhi NCR. Out of our 6,500 senior clinicians, about 4,000 live in Delhi NCR. We are the largest home care business, only profitable one in the country, and almost entirely focused on Delhi NCR. Then we are the third largest lab over there. So in terms of brand, it's a much sort of this thing. And like I said, what we are doing over there today, we have a facility in Delhi NCR, but it performs far better than the flagship of any other hospital chain that you heard of over there. In terms of occupancy, in terms of ARPOB, in terms of EBITDA per bed. And given the location,
I agree.
So for me, I'm solving my own needs. I don't see the same. I don't think the other hospitals are the same size either. Probably half the size.
Okay, they're saving the same number, but you would know. I think you would know much better. Anyhow, thanks for your feedback.
Thank you.
Thank you. The next question comes from the line of Dhiresh K. Pathak from White Oak Capital. Please go ahead.
Yes, so thank you for the opportunity. Sir, for the Noida asset, what is the total FSI potential and how much have been used currently?
It's 18 acres of land for Noida, and I think we can add another 1,000 plus beds. So I don't think, and the present facility is operating at 50%. So there's tremendous potential over there. We keep adding, so I don't think we have a problem in the next decade at least.
Okay, understood. Thank you.
Thank you. The next question comes from the line of Tarun Bhatnagar from Tribeca Investment Partners. Please go ahead.
Yeah, hi. Thank you for your time. My question is on Gurgaon specifically. Now, Gurgaon gets a lot of international patients, so should we assume that once Gurgaon comes up, then your international numbers will increase? And you mentioned on the competition that you have some strength. Any particular competitor who you think can be very tough competitor for you in Gurgaon, or you think that you have much better right to win in that region? Thank you.
Look, every hospital of ours in its micro market, and we have 22 now, is the best performing hospital, with respect to perhaps every line item, including occupancy, significantly higher occupancy. We operate at maybe 75%, and the next closest competitor is at 65%. It's a function of the value proposition we put together. Now, Delhi NCR also, coincidentally, happens to be our backyard. So I am quite confident about what we are going to be doing over there. It's nothing which is sort of moving our competitive intensity or what we believe would have been the outcome. That's where we are as far as Gurgaon is concerned.
Okay, and international numbers, will that see an increase once Gurgaon comes up?
Sorry? International numbers, sorry, I forgot that. No, honestly, it is a destination for international business, but it's very similar to Delhi. So I don't give it a significantly higher sort of this thing. But, in the overall scheme of things, I don't think it's going to really move the needle for us. At the enterprise level, will it significantly increase medical tourism? Answer is no. In any case, in the first year or so, you are going to be taking in all sorts of occupancies, right? Not only international business, but, institutional, otherwise, so on and so forth, like we done in Dwarka. And, so I don't see day one, majority of the beds being filled up with international patients. It also takes time to do that, to mature that business for that particular hospital. So, no, I don't think it'd be a major move.
Thank you.
Thank you. The next question comes from the line of Rishi Modi from Marcellus Investment Managers. Please go ahead.
Yeah, I guess. Can you hear me?
Yes.
Yeah. So Abhay, I'm just looking at your capacity beds. It's around 5,100 beds, and our operational bed count is around 4,654. which comes to a ratio of 90% operationalization. This has been the ratio for the last couple of quarters. Just wanted to understand, historically, we used to do around 95% of our capacity beds were operationalized. Is there are we going to get to that 95, or is it there's a theoretical capacity, but we are using the space for something else, and hence the operational bed count on the existing infrastructure will remain the same?
No, so if I take the example of the last two acquisitions that we did, we acquired JP Hospitals, and along with it, so basically there was a hospital in Chitta and Bulandshahr which have come. They have a 200-bed capacity, and it's operating at 26%. So that leaves out about 150 beds there and then.
26% on 100 beds.
Or 26% on 100 beds.
We haven't opened the 100 beds yet.
Okay, so that's one. But nevertheless, it's basically 150 beds over there out of your 5,100. Then you have the Max JP Hospital, which was acquired, which is a capacity of
500 beds.
500 beds operating at
377.
Sorry?
We opened only 377.
Yeah.
So let me just, so your question is about the operational capacity and available capacity. So I think there are 3-4 hospitals where we haven't opened all the beds. For example, JP Noida. The hospital has the capacity to do up to 500 beds. We have opened only 377 beds. There is some spend to be done to bring that 377 capacity to 500. So we planning for the spend, but knowing that the occupancy on the 377 beds is 52% only, we are not really fast taking that. Similarly, Chitta Hospitals, 200-bedded hospital, only 100 beds opened. We don't plan, and that on that 100 beds also we have only 26% occupancy. So there's no plan to open the balance 100 beds. So that will also require some spend. Dwarka Hospital, I think I mentioned that we opened only 35 beds. The capacity is around 303 beds. So we'll open another 70 beds, and some of them has already been opened as we speak. And then we have, a 200-bedded Bathinda Hospital where we opened only 100 beds. So this is the capacity. I think Bathinda and probably Chitta, leaving these two, I think the others will open in the due course of time. Bathinda, we haven't seen the demand, so we don't plan to really open the other 100 beds. But rest all, will be on board, I would say, in another 8-9 months' time.
Also to the point, all the capacities are real. These are not theoretical capacities, and they don't bring down to operational because of them not being available. They are outcome of the business plan. We don't make them live because the business, some sites may not so ask at that point.
Okay, got it. So in practicality, if the demand is there, you can open up 5,100 beds.
That's right. Yeah.
That's not a concern.
Okay. That's right.
So I think I wanted to understand ALOS, right? So I'm comparing existing to existing, which is around 4.2 days. I just wanted to understand, are we taking any structural efforts to bring ALOS further down on at least the existing infrastructure, or it's more like now we have optimized to a level and hence the fluctuations will remain on account of seasonality of mix?
It's ongoing. It is seasonal and it is ongoing, and it also depends on your clinical programs. You can't even compare any two hospitals across the board. You have to do it on an absolute basis because no two hospitals have the same clinical programs. ALOS by itself is not a bad thing. It depends on which programs you're running. So just to give you an example, higher end business, which is international business, and a higher end surgical program, which is let's say transplant, will always have a higher ALOS, but we'll have a higher EBITDA per bed per day as well. So I think that is what we should be focusing on rather than purely that, unless you have a huge capacity constraint. So at this point in time, we have that. I think the teams do work on discharge and so on and so forth to hasten the discharges, etc., to turn around the beds faster. But if you have capacity, then it becomes theoretical, simply because, if you, whether I have, let's say I had one bed for 365 days, whether I have 365 patients on one per day, or I had one patient staying for the whole year, what matters to me is what is the EBITDA per bed, purely from a financial perspective.
Okay. All right. Finally, I think on the Nanavati piece, you mentioned we've got one block upcoming, and post that, I think we were going to demolish some 260 beds block and then build up a new one to replace it, which net we'll have a higher bed amount. But so just wanted to understand till what period, on those 260 beds at Nanavati, which will be demolished, will we be losing revenue?
No, we are not breaking 260. We are breaking 160 beds. Okay.
160.
Also, these 160 beds are typically a large amount of them are the ones which are not food occupied. We're adding 268 right now. For a period of 2 years, these 160 will not sort of this thing, and then we come back with another 280 beds. Right? So then you'll have 280, 168 plus another, I think, 150, right? Approximately beds, yeah.
Okay, so if I understand it correctly, the current 160 beds which will go under demolition 2 years out, which means in FY-28. Is that correct?
So currently we have a 300 bed hospital. We are activating 280 beds approximately now as phase 1.
So you get to 600 beds.
After
that 580 minus 160.
Minus 160, and we'll be activating another 275 to 280 beds as phase 2.
So the 160 deactivation is happening in FY-26 or FY-28?
These go. Then you have new beds coming. Another 280 beds coming. So for 2 years, you'll have 400 beds. When we deactivate 160.
But these 160 you're saying are not that occupied. Like, I'm just trying to understand the hit on revenue will be commensurate to the bed or it will be lower.
Most of these 160 beds are ward structures and lower occupancy beds. They are the old economy beds. So the idea was to redevelop them any which way. We got a chance to redevelop them in a much better fashion to add a new tower altogether on that area, on that footprint.
Okay, all right. Okay. Thank you.
Thank you. The next question comes from the line of Alankar Garud from Kotak Institutional Equities. Please go ahead.
Yeah, just one small clarification. Had you booked some cost in Dwarka in the first quarter before commencing operations, which are contributing to the full year EBITDA loss of 29 crores?
Yes, we did. You know that this hospital startup was delayed, right? So we are planning for in the quarter 1. So we had higher manpower, and that's the reason, we could ramp it up faster. So there was some loss in the quarter 1. I think it's around 5 to 6 crore rupees, which was also reported. We actually mentioned about it also in the earning updates.
Understood. Yeah, that's it from my side. Thank you.
Thank you. Ladies and gentlemen, as there are no further questions, I would now hand the conference over to the management for their closing comments.
So thank you once again. We will hear from you next quarter. Appreciate all your time.
Thank you.
On behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.